Hey everybody, in this latest Technical Tuesdays post, I sat down with my friend Q Lahre. Quick background on Q. Q was a Pillsbury, Chicago wheat pit trader, co-founding trading partner at Transmarket Group, self-employed KC wheat trader, former member of the Chicago and Kansas City Boards of Trade, and is now the co-founder of StatFutures. In this post, Q and I discussed trading commodity spreads, why and how Q uses stochastics and moving averages for trading spreads, the role Fibonacci numbers play in Q's stochastic and moving average settings, and process for executing trades. Before you listen to the interview with Q, I want to mention the Technical Analysis Guide by RJO Futures. I have it downloaded on my desktop, and it's a great resource for the basics of technical analysis. Now, if you're interested in learning about the basics of technical analysis, or you'd like to have a solid resource on your desktop, I recommend you download this free PDF, which is located on our website in this post. So without further ado, let me take you right to the interview with Q. Q, what is your current style of trading?
Well, Anthony, as it has been since probably 1985, large spreads, relationships. It has really been my bread and butter, since about 3 or 4 years into my trading career.
I know that you trade commodities primarily. Talk to us about why you trade the spreads.
Well, I came up through the Pillsbury system in the early 1980s, and the commercial background that I've got, in the trading systems, and Pillsbury insisted 24/7 that you were hedged, so spreads were really a way to, as back in the 1980s with no margins, we played mark to market on spreads. You could have huge positions with literally no margin back in those days if you were up on the trade. So it seemed to me the logical way coming out of Pillsbury for me to evolve into spreads and relationships.
Can you give us a little bit more detail on the spreads that you're trading?
Well, for instance, I always look at, everybody today calls them the calendar markets. Of course, the inner markets, KC Chicago, wheat corn. And as you know, Anthony, I'm a wheat trader, have been since day one. 99% of what I do is wheat. So it's the 3 wheat markets here in the United States, plus around the world. So, I'm also looking at the deep backs, as we call it. So, I really got my eye on what's going on in 20 and 21 in the crops right now in all 3 markets to see if there's any opportunity and, to really get into something or see if the commercials are actually doing something out there that we can begin to build a narrative about what's really going on in one of the 3 wheats or all 3.
And what is your hold time for these spreads?
Well, I hold them for however long it takes. So, I would trade big size, as you probably know. And for instance, the Chinese would come in and want to price, something in 2020 with me for, like 3 million, 4 million, 5 million bushels. And what I would do is give them a price and then lock it into a relationship. So a butterfly or a tandem or KC Chicago or Minneapolis, Chicago, whatever, so that I could literally put that thing on and hold it for months at a time. So, I would rarely day trade. I mean, I was in and out of stuff on occasion, if just to pay the bills. But my bread and butter, all the units that I traded were for 3, 4, 5 cents on 1,000, 2,000 stuff.
You say you hold them for as long as it takes. What's a typical hold time for you in one of these spreads?
3 months would be about average.
So 3 months would be about average. Now, Q, I know you use a lot of fundamentals. This is a Technical Tuesdays post, so we're going to talk more about the technical side of things. What are your favorite technical analysis tools, and why did you choose to use them for trading these spreads?
Well, the thing is that you can also apply the technical tools to the spreads. And what I really look at is stochastics and moving averages. And to be honest, that's about it. From an indicator standpoint, I always look at the charts because, as we talked about last time I was on with you, the market is the answer. So, the charts are the answer that I'm looking for, and then the indicators will give you the reason for that sort of thing. So, I'm sort of a physicist looking at the markets, which is I want to know why something happened so that if I see it again, I can snap on it. I think a lot of the young traders around today are seeing, they're just looking for indicators to tell them what to do, as opposed to understanding what these indicators actually mean in certain circumstances.
Well, let's continue that conversation then. So explain to us how you're using these stochastic and moving averages and why you chose them for trading spreads.
Well, what I discovered, especially about stochastics, was that when a market breaks off a low, and then the stochastics go from 20 to 90 or 80 or something like that, and people say, well, you should sell stochastics at 80 or 90. What I see is that's a first wave in the physics of a turn. So it's almost like I see 2 to 3 waves, where the third wave of an 80, 90 in a move is where you can actually start laying the lumber into a spread or the market itself. And like I said, the spreads can be stochastic, the same as the flat price market. So, I'm looking, let's say, KC Chicago. And I mean, if you look at that over, with a 50-day moving average and the base stochastics, you begin to see what I'm talking about as far as these spreads. And, I've got a bigger, frame of looking at what's going to happen. So, I don't get stopped out by this noise in the markets. And, most of the time I'm digging into a move as it's moving up. So, what I found over the years is that if it's moving up and it's starting to get exhausted, you've got to get into the market before it turns, because there's a vacuum once it turns, whether it's going down or going up. And of course, I think we just saw that in the stock market here and nat gas both ways. So, just this last week. So it's really, you've got to learn how these stochastics and the moving averages play into the psychology of what the market's doing, in a longer term. And by the way, Tony, we talked about that last time, which is where, I was talking about a lot of people are looking at the bark on the trees, where I'm always looking at the forest.
Yeah, no, we have talked about that. And something I'm curious about, because I don't trade spreads, so this is all really kind of new to me, and hearing on how you chart a spread. So are you looking at multiple charts of all different spreads, or are you looking at the so you are. Okay. So you pull up the same indicators on just multiple spreads, and then you're just looking at them across the board.
Yes.
Okay, so talk to us about the settings that you're using for stochastics and what moving averages you're using.
I use 3, 5, 13 stochastics, all Fibonacci. Wheat is like totally like human food and human everything. Fibonacci seemed to work, and I'm very comfortable with that. Moving averages, I use Fibonacci days. I don't use 50-day, I use 55. I use 89 instead of 100, and I use 233 instead of 200. So there's a little bit of secret sauce for all of your listeners. Everything I use is Fibonacci. Everybody thinks I'm out of my mind here in the continuum, because I'm one of those real OCD people about math and Fibonacci's and prime numbers and stuff.
How, by using these Fibonacci numbers in the moving averages, do you feel that gives you an edge?
What it does is it tells me, especially the 233s, the year average, shows me the what I call the inertia behind the market and behind the moves. Okay, if you think about this in terms of physics, and this is a show about technicals, but if you think about it, physics is technical, and if you think about it, to move wheat from $3 to $4 and have 400,000 contracts, that the physics it takes to lift something a dollar that's that big, and that's where I begin to see when the moving averages begin to turn, it shows me we're smelling a bit of exhaustion of a big move. So that's how I apply the technicals, and like I said, I'm looking for 60, 70, 80, 90-day trades that are going to really come in, as opposed to whatever the point of control is on the market today and trying to get in and out without having to pay any margins on open interest. I mean, I live for open interest. I do not live for volume.
Why is that?
Because spread traders, if you're really deep into spreads, it's all about open interest. Volume really doesn't matter. Because I will sit there and, I used to do, 1,000 watt with China in the deep backs. And then there wasn't a pound of wheat traded in that for like 10 days. And then all of a sudden somebody else would come in and trade a 10 lot or a 5 lot. We'd begin to, move some stuff. But, it did not bother me that there was no volume. It was like, I was comfortable where I was selling it to China. And China, of course, had their mills priced in on the buy side. So we were happy with each other, and we were all priced in, and they got what they wanted, and I got what I wanted. So it was a much more what I call collegial relationship once we got past the first 3 or 4 contracts of wheat in all 3 markets.
So we talked about how your average hold time is roughly 90 days, and we talked about how you're looking at all of these spread charts using the same indicator, so very consistent across the board. Do you have a specific time frame for each one of these charts that you're looking at?
What I do is I look at, I try to keep it around 6 months.
So it's a 6-month chart, but is it a daily? Is it a weekly? Is it an hourly? So it's all daily charts.
Yep. If you're a spread trader, it's pretty much EOD. In the day is the data. Every once in a while, I'll especially look at what I call the x-axis volatility. So, like, what that is the range of the day. If it starts to expand, then I know that there's another signal for me to keep an eye on things. So, outside of WASD, where you can have a 20-cent intraday swing in wheat. But if you begin to if it goes from 3 cents to 5 cents on a daily basis, or 5 to 10, something is brewing inside the market. So I'm just looking, I use technicals as indicators for, what is the market thinking? What is the market doing? And, is there something imminent? And, that's where my, 30 years of experience is that, when something starts to bubble and we're down in the lows, it's like, you better clean up those short calls and that sort of thing, and make sure that, you're not short old crop, new crop, on a turn.
To me, it sounds like you are easing your way into these positions. You're not looking to try and find tops or bottoms. You're trying to look for times when the market appears to be turning. So what's interesting to me is going to be how you go about executing this now. So we've learned a lot about your process so far today. Now take us through your process for entry. What are you needing to see through the stochastics, through the moving averages for you to start anticipating a possible entry? And also, I want to add how you determine a stop.
Okay. I learned this early on in the trading pits. The successful people down there were able to think clearly under enormous stress and extremely loud noises and chaos. And what I did was I would do my work at night, determining what I was going to sell and what I was going to buy. So in other words, right now, there are certain things that I know that have to be sold, in the deep backs and wheat. And what you look for is when the bids show up and then you hit them. So in other words, it's about counterpunching. And that's where the positions get built is waiting to counterpunch. And I think a lot of traders, try to punch instead of counterpunch, and let somebody else, figure out the entry point. Now, as far as stops, there are levels, based on the frames that I was talking about that I use, back when I was talking with you in April. Those frames tell me when I'm wrong. And it's like, when I'm wrong, I just blow it, take my hickey, and then, move on. So, generally what will happen is I'm usually laying into something, 1.5, 2.5 standard deviations above the mean against my frames statistically. And then what happens is if we get a, 3.5, 3.75 standard deviation, print, then I say, okay, I'm wrong. I've missed something. And then I just take the hickey, figure out what happens. and then move on to the next one. So, stops on the upside, stops on the downside are both the same thing. I have frames in mind about where I'm right and where I'm wrong. And, I just learned to do this on those trading floors in the middle of chaos. And it's really a lot simpler now, sitting here quietly, listening to the Doors and Jimi Hendrix.
Okay, so a couple things I'm not clear on yet. I'm an outright trader, not a spread trader. So for me, I always have a hard stop. And to me, it sounds like you don't have a hard price stop and you have a standard deviation move away from where the market is before you get out. So explain how you manage your risk that way, because to me, it sounds like you could be risking a lot more maybe than you want to be.
Well, generally, I started really getting serious about it, back in the day when the position got over 1,000 contracts. So, then you begin to say, okay, if this thing turns, I'm going to drop, $200,000-300,000. And, basically that was pretty much, my level. I took a couple of $300,000 and $400,000 hickeys over the years, but, the winners were, 3, 4, 5 times that. So, it was pretty standard, finance 101, 3-to-1, 4-to-1, 5-to-1 risk ratio to reward. And it worked out good because it seems with my finance degree from Indiana, and then my statistics, building the frames that I had a solid understanding of, where to get in to limit the risk and, where I was wrong. And, pretty much every trade that I took a big hickey on, I could have lost $2 million, $3 million on it because I was, the thing is I was dead wrong, but I got out and, that was the best $200,000 or $300,000 I ever lost in my career.
So I'm sure a lot of people out there are listening and saying, well, I can't risk that kind of capital, Anthony. But what you're doing with the spreads, you could scale it as small or as big as you like.
Yes. And the thing is, when I started, I was trading, onesies and twosies. And, but it's like every time, like we talked about the first time you and I talked, about 2 years ago, is, sometimes the sky's open and you got to go for it. And, that's where you find out what you're made of as a trader. When, you trade that first 100 lot, 200, 300 lot, then somebody comes in with a 500 lot spread, you just say sold, because, it's where you say you're going to do it. And it's really, it's Tucker time. So you either do it or you don't. And that's the difference between the big traders and the people who think they're big traders.
Yeah, I've talked about that many times in the show. I call it testing myself. Mm-hmm. And you really sure do feel alive when you go a little bit over your skis. But at that moment, you realize where you really are as a trader.
Absolutely. Well, I'm sure you've heard the story about Tom Willis the first time he traded 100 lot in the bonds, and then the first time he traded 1,000 lot in the bonds, and it's just like you and I mean, I'm a wheat trader, and that would that's like real man territory for us. So like you said, it's definitely over your skis, but it's like that's why people are still talking about Tom Willis 30 years later.
Yep. What I've learned so far is your process for entry, how you're managing your risk within these trades. But with stochastics and moving averages, I understand the process for entry now. But how are you determining exits? How are you determining any potential targets?
Well, what happens is once the market turns my way, there's a vacuum, and it's just like the money just flows into my accounts. And then the second that we begin to find trading levels, once I'm deep in the money, I'm beginning to look at my exits. And, that's where I'm looking at, are there seasonals? Should I be here, 2, 3, 4 months when I'm doing this stuff? Am I going to go into a seasonal that really is going to go against me if I keep holding this too long? So I'm one of those where once I get the money flowing into the bank account, it's really about, that's the second I start thinking about when I'm going to get out. And what I generally find is that there's a flow of volume down at the bottom and the flow of volume up at the top that lets me get in and out. And, I never tried to pick the turns, and, that's for the real heroes. But you tear chunks out of the market. And that's what I tried to do was, get long and ride it, and get short and ride it. And I mean, if you think about it, I was essentially a spread trader that behaved a lot like those turtles, because I mean, those guys would just come in and get long, and they get long wheat, and if it wasn't right, they get out. They come in again, get it, do it again. All of a sudden, they caught the big move, and that's what I learned from those guys, was watching them, was that they never missed a big move, but they sure peed a lot of money away, trying to time it. And we talked about timing too being the hardest part of trading.
Yes.
So I learned quite a bit from watching the turtles back in the old days.
I think that's one thing that's very interesting to me as a spread trader like you versus an outright trader like me. I have to have a target because I'm an intraday trader. So I need to know a level where I think it can go. Now, I may not hold it to that level, but for me, visually, I need to see it, because if it gets near my level of exit, then I'll make a decision on whether or not I want to get out. Because being an intraday trader, if it comes back X amount to where I get in, that could be the whole day for me. So targets are very important. But what I like about the spreads, and hearing you talk about this, what your time frame is that what you're doing is you're getting yourself into a position, and then when it starts to go your way, you're now able to look at everything, and you're now reacting to what's happening in the market. Like you said, it gets into the money, and now you're going to let the market get you out.
Yes, indeed. And the thing is, Anthony, I respect all you day traders. I couldn't do it in a million years. I mean, I'd be broke if I had to do that. It's just the market created me. The market finds functions for people, and find niches, and the people who fit it, and the market provides you a lifetime income. And the thing is, what you guys do is really, I respect the hell out of it, because I could never do it. I'd be broke. I would have been broke, 20 years ago, trying to day trade.
And I think what you're saying, and what's so important, is that we have to find something that fits us as a person. It has to fit our personality, because for me, I'm the exact opposite of why I can't be a long-term trader or maybe even a spread trader and hold them for 30 to 90 days, because I always want to be flat. So for me, I may be trading a lot more active than you when I am trading, but my whole goal is to be flat. And so for me, I almost feel like I have to be forced into a trade to do it. So once it gets to my level, I'm like, okay, I have to trade this right now. Versus in the way that you're doing it, you already have this long-term mindset to where you're getting into it saying, you know what, I'm starting to get in now. I'm dribbling my way in. And now you're holding that position for so long. I mean, I know it's a technical show, but I want to get into a little bit of mindset, because I think this is important. How do you deal with that throughout the trade? Like, what is your mindset once you get into knowing that you may have to hold this for several months?
Well, the thing is, I learned this at Pillsbury. And see, Pillsbury, we have what we call programs. And because, we would sit down, let's say in February, and we said, okay, we're gonna get long about 8 or 9 million wheat, to put our mills from, July through February, next year. And then what we would think about is, we're going to buy 8 million wheat, 9 million wheat, 10 million wheat, one of those 2 or 3 numbers. And then we had to figure out where we were going to buy it. And I learned about being patient and, looking for these points. And when somebody would come in and, put it down 5, 6, 7 cents, I'd get the phone call from Minneapolis, and they'd say, just take that, let's go. We're going to put that in inventory for the mills. And so I learned about building a program. I learned about patience. And then I watched how, the thing is that when I would build a big open interest position, especially in the backs, it had gravity. And, and the thing is that I was trading with the biggest traders in the world, the Chinese, the Russians, the French, Cargill, Continental, Dreyfus, all those boys, Bunge. And the thing is that, we would share a little bit of information, and we all respected each other. So it was like there was 2 different worlds in the wheat pit, the front 2, 3 options. And then, the back was where, all of the major machinations of what was really going on in wheat were really happening. And it really suited my mindset to build programs, with my math and physics and statistics background, to build this program. And then what I saw was once the program got in and I had its big position, everything I saw in the market was just noise, blips. Whereas, it's big stuff for you guys, but yet I was watching, the market ebbing and flowing, more like a liquid. And, we can get into this the next time you and I talk, but, I got deep into, fluid dynamics, studying the markets, especially in the backs. So it's really interesting. And there's very, very few people like us, that trade, deep in the backs, big positions. But, you'll find that we're pretty much all the same mindsets.
Yeah, I definitely going to have a follow-up conversation with you about that. Last thing for today, Q. You taught us a lot about your process today. Can you now take us through a trade that you're currently in or even eyeing and walk us through why you either took this trade or you may take a future trade?
Well, the thing is, I've sent you the recent July corn and the recent July wheat charts, July 2019s. And, we talked, last time we talked about, the soybeans and the tariffs and blah, 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 whatever. But what I wanted to show with that chart, and the reason this is getting me very, very interested in what's going on, is if you look at that corn chart, it looks a lot like the bean chart, okay, which is, it broke from 1060 to, 860, $2. Everybody's blaming the tariffs in Brazil, but yet why is the corn broken like that? So, these are the sorts of things that keep me up at night is, the corn is broken from 440, 450 in July all the way down to 365 or 370. And it's virtually the same percentage as the beans broke. And of course, my explanation is that we've, we had a 10, 12% break in the Brazilian real. But what this shows you is the technicals confirm the fundamentals. And, in my opinion, you've got to have both to really, really crack the big nut in futures. And what this is showing is that corn chart is showing that there is something big going on in the grain markets. And, we're having a major seismic shift happening. And I don't know exactly what it is yet, but I'm beginning to get suspicions, out of Russia and China, this one belt road thing that we talk about. And of course, the bigger crops in Argentina and Brazil. But, this isn't, there's maybe 30, 50 cents about this in tariffs, but, this big move is more about what happened in Brazil with the real and what happened with, the bean yields going from 49 to 53, which was another, 8, 9, 10% bump in yield. So, people, the thing is what I learned early from day one is that you've got to figure out why exactly the market did something. And then you can begin to respond to it. But if you look at the wheat chart that I showed you, the wheat got buried just like they did, but yet it bounced off hard. So what that shows me is that we talked about this as well, is, when do we know that the bottom is in? And you begin to see those sorts of things where, the bottom is in, and if anything happens like the Argent or the Australian drought in wheat, this market took off in wheat before it got itself recalibrated. So, from a technical standpoint, you can talk about, on the corn chart especially, it broke through, it gapped open, under the trend line, pretty much the standard stuff they talk about at technicals. But it's really about why did it do this and why did it do it with beans? And, as you know, I sit here in the continuum and I live in a very, very deep world of futures that I look at everything going on and read constantly. So it's really about, human behavior especially with this corn and beans right now, because there's just so much emotions, as you've seen on Twitter, about beans, especially in tariffs, blah, 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 whatever, about those sorts of things. But the question is, why did corn do the same thing? And, that's what's keeping me up at night right now. So that's what I'm looking at like a hawk at the moment, because what that's showing me is that, wheat's got a bottom in, plus or minus $5 in the July, but, corn is close to it as well. So what that shows me is you got to be careful. And, the charts are broken out, but now what do we go from here? And of course, what that means is I'm going to begin to look at, the July East corn spreads, in the backs. and the July D sweet spreads in the backs to begin to see if we get a signal that this thing is going to turn. So, and of course the July no, new crop July no spreads in the soybeans. So, this is the world I live in from a technical standpoint. Is I get big signals, and then it's like, okay, now what do we do with it? And do we get confirmation from everything else in the complex?
I totally get it, Q. So what you're looking at is you're looking at relationships in the markets that you watch.
Yep.
You're understanding the fundamental themes, and you're seeing if that's now going to give you some confirmation or contradiction with technicals.
Yes. And it's like, I can't believe people aren't sitting around saying, what in the hell happened to corn since, May when you and I talked. Because, beans did have the tariff thing, but yet the Brazilian real did it. But if this is all real, then, we're living in a new world. And that's what I'm trying to figure out. So, thank God this is the end of the year where it's, the markets will slow down a bit because, I think something major is coming in the next 2-3 months. So, that's what I'm looking for and looking for the signals and the spreads and the relationships about when and where something's going to happen.
Great stuff today, Q. Where can people find you on Twitter?
Twitter, I'm at StatFutures.
And what about a website?
I am evolving my company. I've merged with Connect the Gray in Minneapolis, and that's Grey, connectthegray.com.
Once again, Q, it's always great to speak with you. Thank you so much for joining me today. Look forward to our next conversation.
Always a pleasure, Anthony. Call me anytime.
Thanks for tuning in for Technical Tuesdays. Remember, if you're interested in learning more about the basics of technical analysis, or a veteran like myself who likes to have a basic technical analysis guide for referencing, please download the free technical analysis guide on our website under this Technical Tuesday post. Cheers, everybody.